Hello there, my name is Alfred, and today I'll be going over the third lesson, Investing 101. What is investing? To put it simply, investing is setting aside some money for assets such as stocks or bonds in hopes of that asset increasing in price or that asset being able to generate future profits, such as in the form of revenue or interest, etc. The four main types of investments you'll see are stocks, bonds, real estate, and insurance. Let's have a look at an example of an individual making an investment. Let's consider my friend James, and he purchases a share of Apple. Here, he's investing into a stock, in this case, Apple, and he's hoping that Apple will increase in price so that he can take advantage of that capital gains, where he will sell it at a higher price, yet he still bought it at a lower price, and he will profit that little difference. At the same time, James is accepting the fact that he might lose out on some money if Apple decreases in price, where if he bought it at, let's say, $50 and the price drops to $30, he's actually losing $20. And that's the main difference that separates investing with savings, where investing, you're putting aside money into more riskier investments or assets over a longer period of time. Now let's look at some examples. So stocks, like I've gone over just recently, these represent an ownership or part of a company. So if you think about a pie graph, you'll see that it's each section or each part of a corporation. You have two main types of shares. These are common and preferred shares. Common shares are typically shares where you have the ability to vote in a corporation for company matters, whereas on the other hand, preferred shares usually come with priority for dividends. So when people invest in stocks, they usually consider the ability to generate revenue, and this either comes from capital gains, like the example with James, or through dividends. So with dividends, you are paid either quarterly, it's usually quarterly, and preferred shares usually have priority. So they're the first ones, or preferred shareholders are the first ones to get those dividends. Stocks tend to be high risk investments where or moderate to high risk investments where some stocks may be extremely volatile, whereas some other stocks are less volatile. And it kind of depends on the type of stock. And in general, stocks are pretty liquid assets as you're able to trade them. You're able to buy them and sell them on stock exchanges like the New York Stock Exchange as well as the Toronto Stock Exchange. Moving forward, I'll go over bonds, and bonds are more or less debt securities that are issued by corporations and governments to raise immediate funds. So when, let's say, the government wants to construct a new highway, yet they don't have enough money, they'll issue they'll issue bonds to fund for that project. And typically consumers will buy that bond, and this will be a low risk investment as the government usually they are backed by the full faith and credit, as well as corporations typically have assets as collateral when issuing out bonds, and they're able to show that credit. So consumers will actually buy that or purchase the bond. Bonds typically vary in liquidity, and this really depends on maturity. However, they are pretty liquid. You're able to trade it over the counter, yet at the same time, they're not done on an exchange. You, if you do want to purchase a bond, they're usually done with the help of a broker at a financial institution. So let's say at a commercial bank like TD Bank, a broker might help you make that purchase if you want to buy a 5 year, um, let's say Treasury bill or a 10-year government Bank of Canada government bond. Next, I'll go over real estate, and real estate is more a long-term investment where you're buying either land or property. So yet kind of similar to stocks, you're owning a property or land, and the ways you make money or revenue from this is through renting or through capital gains. So you either rent it to another consumer or yeah, you rent it to another consumer and they pay you monthly rent, or you hope that your property or your real estate increases in value so you can sell it for a profit. At the same time, real estate is mostly moderate risk as it's affected by geography and location. So if you live somewhere in Toronto where housing is extremely demanded, then price will again affect that, and it typically can be pretty volatile. However, if you compare it to somewhere more north of Canada, let's say in Yukon, the demand isn't there, and typically you won't have much volatility in price, and it'll typically stay pretty stable. If you don't want to buy out a whole apartment or 50 acres of land, then many consumers or many investors do decide to invest in real estate investment trusts, which are typically like funds that funnel in a bunch of properties such as apartments, condos, housing, land, and this is a way to buy into a bunch of real estate without actually purchasing it or without actually owning it itself. Real estate is typically illiquid as it takes a long time to sell and find a buyer. And in short, you can find real estate investment trusts on stock exchanges, real estate ETFs as well on stock exchanges. However, buying the home or buying the land itself, you usually do those with the help of an agent or through property listing websites. Finally, I want to go into insurance. And insurance is not as obvious as an investment. However, many individuals do decide to purchase insurance as a long-term investment to protect themselves against financial risk. So basically, how insurance works is that you purchase it, and then if you get into, let's say, a car accident, then the cost of the repairs for the car actually get transferred over to that insurance company. And it's a way to more or less transfer risk. There are many types, such as auto insurance, health insurance, liability insurance. However, each insurance plan consists of a policy limit, deductible, as well as a premium. So a policy limit is the maximum amount that an insurer will pay. So if you get into a car accident and the repairs will cost $1,000, the max, let's say a policy limit will cover, let's say it's $800, then you'll still have to pay 200 out of pocket, as that insurance plan will not cover anything above $800 in damages. A deductible is the amount you have to pay out of pocket before your insurance plan even begins, and this is usually charged annually. And you, as an example, if you get into a car accident, like with the same example, then you'll have to pay. Let's say your deductible is $200, and then you get into that same car accident. Um, your the insurance plan will cover the other portion of that damage. So they'll cover the $800, whereas you only have to pay $200. Finally, each insurance plan consists of a premium, and this is the monthly cost to receive coverage. So you'll pay this on a monthly basis, and this is typically affected by various factors. So if you're older, if you smoke a lot, then let's say for an example, health insurance. Your health insurance premiums will be much higher than somebody who is younger and who lives a healthy lifestyle, who's running, who's active every day. As elderly individuals who smoke frequently typically have a higher risk of getting into of getting health diseases, and it poses to insurance companies as a high financial risk.